My name is Ronnie Michael, certified public accountant, and this is the Personal Finance Playbook. Improve your finances, improve your life. The title of today's episode is Explain Like I'm Five How Your Tax Return Works. Why do we pay taxes? Well, as the legendary Ned Flanders once said, taxes pay for policemen, trees, sunshine, and for people who just don't feel like working, God bless them. Now, with that question answered, have you ever thought about how your tax return actually works? Sure, you get taxes withheld from your paycheck throughout the year. Then you file your tax return and get a refund, right? Well, there's a bit more to it than that. Let's cover the basics on how your tax return works and explain why getting a refund on your tax return is actually a bad thing. Here is IRS Form 1040, U.S. Individual Income Tax Return. So many people nowadays use a third-party online service like H&R Block or TurboTax to file their tax returns. So I'm not even sure how many people have seen what your actual tax return looks like when it's submitted to the IRS. It's only 2 pages long without all the supplemental schedules and forms. Now, before we dive in, let me offer one important caveat. The tax code is long and complex, and while I am a CPA, I am also just a guy on the internet. As of 2014, according to the Tax Foundation, the tax code was 2,652 pages long and contained about 1 million words. By comparison, the entire 7 book Harry Potter series also contains around 1 million words. The King James Bible has nearly 800,000 words, and the novel War and Peace has 560,000 words. When you factor in related IRS documentation and relevant case law, the amount of federal tax law documentation comes out to around 70,000 pages of material. If you were to physically print out 70,000 pages, the stack of papers would stand about 23 feet tall, or about the length, or excuse me, about the height of a 2-story house. Individual income taxes, which is the most relevant when it comes to your tax return, is only one component of the tax code, but this hopefully gives some perspective on the complexity involved here. Here's a basic framework for understanding how your tax return works. First, you report items of income. There are rules for what types of income to include and what types of income to exclude, but pretty much any money you made during the year is going to get reported. You determine your adjusted gross income, or AGI. Next, you report your deductions. You can take something called the standard deduction, or you can choose to itemize deductions. Like with income, there are rules for what deductions are includable and which are excludable. You unfortunately can't just take deductions for whatever you feel like. Next, you subtract your deductions from AGI to determine taxable income. The appropriate tax rates are then applied to your taxable income to calculate your tax. This tax amount isn't final though. Next, you determine if you qualify for any tax credits. Lastly, you subtract any tax credits from the tax to arrive at your total tax. That wasn't so bad, right? We can dive into the components of the tax return, but first let's go over filing status. After filling out identifying information like name, address, and social security number, your tax return asks for your filing status. Filing status most notably determines which tax rates will be applicable on your tax return. There are 4 main filing statuses. 1. Single, which means you are unmarried. 2. Married filing jointly, which means you are married and you are filing a joint tax return with your spouse. Most people are going to fall into these first 2 buckets. 3. Married filed separately, which means you are married and you are filing a tax return separately from your spouse. And 4. Head of household, which means you are single, but you take care of at least one dependent. Note that filing status is determined by your status on the last day of the year. So if you got married on December 31st, your filing status on your tax return covering the entire year would be either married filed jointly or married filed separately. Now, let's talk about what income to include on your tax return. You must first report gross income, which is defined in Section 61 of the tax code as, quote, all income from whatever source derived. For most people, this is going to mean wages from their job. but it also includes things like Social Security benefits, pension income, dividends, and capital gains. Capital gains are any profit you made from selling a capital asset, like stocks, bonds, or real estate. We'll get into capital gains a bit more when we talk about tax rates. When the IRS says that you need to report income from, quote, whatever source derived, they mean it. As laid out in the IRS's 2023 Guide to Your Federal Income Tax for Individuals, this means you need to include bribes, income from illegal activities such as dealing illegal drugs, and the fair market value of any property you stole unless you return the property to its rightful owner. Deductions are a bit trickier than income. First, let's discuss above the line deductions versus below the line deductions. The line being referenced here is adjusted gross income, or AGI. Some common above the line deductions are contributions towards a health savings account, contributions towards certain retirement plans, and student loan interest payments. These deductions reduce your AGI. Having a lower AGI is generally better, as there are certain below the line deductions and tax credits that can be limited if your AGI is too high. For below the line deductions, you, the taxpayer, have a choice to make. You can choose to take the standard deduction, or you can choose to itemize deductions. The standard deduction is a flat amount determined by the IRS and adjusted for inflation each year. The exact amount depends on your filing status. For single filers for 2024, the standard deduction was $14,600. This essentially means that the first $14,600 of income you earn is tax-free. You get an additional deduction for being blind and an additional deduction for being over the age of 65. If you choose to itemize deductions, you can deduct certain expenses you made during the year. Some common examples of itemized deductions include out-of-pocket medical expenses, i.e. things that weren't covered by health insurance, state and local property taxes, income taxes and sales taxes, interest paid on a home mortgage, and donations to charity. Note that a lot of itemized deductions have limitations on the amount you can deduct. You wouldn't want to itemize deductions unless the amount of your itemized deductions was greater than the standard deduction. According to statistics published by the IRS, 87% of taxpayers in 2020 took the standard deduction. We arrive at taxable income by subtracting below the line deductions from AGI. Next, we need to apply tax rates to calculate the tax. Tax rates are determined by a combination of your filing status and your taxable income. A common misconception about tax rates is that there is a single tax rate which determines your tax. The truth is that there's what's called a progressive tax system, under which you are taxed at higher rates for each additional chunk of taxable income. Here's a table of the tax rates for 2025. Let's say you had taxable income of $100,000. That would place you in the 24% tax bracket. That does not mean that you would take 100,000 and multiply it by 24% to calculate your tax. Instead, you need to calculate the tax separately for each chunk of income. The first chunk is multiplied by 10%. The next chunk is multiplied by 12%. The next one is multiplied by 22%. And the last chunk, up to $100,000, is multiplied by 24%. If you add the results for each chunk of income, you will arrive at your tax. One thing to note, capital gains can potentially be taxed at a special lower tax rate. There are two types of capital gains, short-term and long-term. Short-term capital gains relate to the sale of a capital asset which you owned for less than a year. Short-term capital gains are taxed the same as ordinary income, i.e. what we just went over. Long-term capital gains relate to the sale of a capital asset which you owned for more than 1 year. Long-term capital gains are taxed at a lower tax rate, either 0%, 15%, or 20%, as laid out in this table. The last component of the tax return is tax credits. A tax credit is a dollar-for-dollar reduction in tax. Some common tax credits include the Earned Income Tax Credit and the Child Tax Credit. If we subtract tax credits from tax, we finally arrive at your total tax. Now that we've calculated the total tax, we need to determine if you're getting a refund from the IRS or if you owe the IRS money. If your total tax is less than the amount of tax withheld from your paychecks throughout the year, you will get a refund of the difference from the IRS. If your total tax is greater than the amount of tax withheld throughout the year, then you will owe the difference to the IRS. Contrary to popular belief, you do not want to be getting a refund when you file your tax return. Think about it. You get taxes withheld from your paycheck throughout the year. Then you file your tax return. As a professor in my graduate program once said, the tax return is like your final settlement with the IRS. If you reach your final settlement with the IRS and the IRS owes you money, that means the IRS took too much money from you during the year. The refund you're getting is money you should have had during the year, which you could have used to buy things or invest in something. It's like you made an interest free loan to the IRS, which the IRS is now paying you back by issuing a refund. Now, with all that said, in the grand scheme of things, a refund isn't hurting you too much unless your refund amount is gigantic. If you find that you're consistently getting a sizable refund every year, you may want to consult a tax professional or check how you filled out your Form W 2 at work to make sure your tax withholdings are correct. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.